Hello ladies, good morning, hope you're all well. I'm just going to go through some work on different types of market structure, which we will come back to and look at again in year 2, but this is particularly relevant to the coffee market question that you're looking at the moment. And one thing that we were going to do on Friday is do like a live lesson to just run through some of the planning process, but I think this content will certainly help you with a couple of the questions, a couple of the longer questions that I've asked you to consider. Okay, so what we'll do is run through this, and obviously if you've got any questions after having viewed this content, then please let me know and we'll run through anything that we need to. Okay, so excuse me. So we're going to talk about oligopoly in particular, and this is to do with a particular type of market structure that is going to be particularly relevant to you when you come to look at the coffee market and try to answer the questions in section 1 on the paper that I sent through to you. And I know some of you have already had a look at it. So one thing I would say is that some of the contents that you would be expected to know based on this A-level paper, we haven't really covered in a huge amount of detail. We've touched on bits, but we haven't covered in a huge amount of detail. So we're going to take a look at oligopoly particularly because that is pretty relevant in terms of market structure. So we're going to look at concentration ratios. We're going to look at competition in an oligopoly. We're going to look at something to do with interdependence and price stability, and also some of the things that happen in oligopolistic markets, where in some cases we might have tacit agreement, and in some cases we might have some price discrimination too. Okay, now again, I'm not going to go through a lot of the illustrative theory and diagrams that you need to know, although they are on the PowerPoint. We'll just be looking at the key things that you need for helping to answer the question in that are posed from the exam paper. Okay, so let's take a look then. In terms of market structure, and there is a huge spectrum of market structures that we'll need to be aware of. And as you can see, basically, they range from something called perfect competition through to monopolistic competition, then to oligopoly, and then to monopoly. Now, as you can see, this sort of continuum basically shows that perfect competition is as it suggests, where there are perfect conditions, there are a large number of buyers and sellers, you've all got exactly the same product, and we are price takers in that the market decides on the price that we will have to charge. We can't influence, we're not big enough, we don't have enough difference in our product to be able to justify a price increase or a change from what else is being offered on the market. Okay, so that's perfectly competitive markets. Okay, now clearly, dependent on the type of market that you're in, will also determine the type of behavior that you're going to exhibit within a market. The second, so obviously a perfectly competitive market is the most competitive market that you can get, in that you've got a large number of buyers and a large number of sellers. If we move then one up from perfect competition to monopolistic competition, that's again where you've got a large number of buyers and sellers, but in this case you've got what's known as differentiated products. Okay, so they may not be very different from one another, but there is some element that is slightly different. And as a result of that difference, you are able to then make a price or come up with a price that you want to charge because you feel that you've got something different from the rest of your competition. Okay, so that's what's known as monopolistic competition. As we move to the right, to my right, probably to your left as you're watching this, we then move to something called oligopoly. And again, some of you might be familiar. We have touched on oligopoly before. And this is the area that I want you to think of most specifically when it comes to looking at answering the question, when it talks about market structure in, I think, question D, I think it is. So oligopolistic markets are where you have a few firms that dominate the overall market. Okay, so examples would be the coffee market or the coffee shop market. But you've also got, in addition to those few firms that dominate the market, you've also got a plethora of other providers, generally speaking, tend to be a bit smaller, but you've got this market where you've got a significant number of firms, or a significantly dominant market share being, I'm not phrasing this very well, basically. Let's start that one again. So you've got a few firms that dominate the market, that hold a very high level of market share, although you've still got others that also are in that marketplace. And the least competitive is where we're in a monopoly position, where effectively in a pure monopoly you would have just one firm producing all of the output. Now, as you can see, in monopolistic, oligopolistic, and monopolistic competition, oligopoly and monopoly, you are in a position where you are a price maker, because there's some difference, or there's some advantage, or you have a dominant market position that allows you to determine the price that you're going to charge. Okay, so the one area I want us to focus on, particularly for the example that we're looking at in the coffee market, is the oligopolistic market structure. Okay, and we'll run through a little bit more detail on that in a minute. Okay, excuse me. So looking at how the market structures and how their characteristics vary, you can see here we've got a table. I'm not going to ask you to fill it in. I'm going to fill it in and talk through it together. So we've got perfect competition, monopolistic competition, oligopoly and monopoly. And then we've got the number of firms, whether there are barriers to entry or exit, the nature of the product, the firm's influence over price, and then some examples. So we're just going to run through these as a process. So we mentioned that in perfectly competitive markets, you are a price taker. The market price dictates what you can sell your product at, because there's no difference in your product from any of the competition. You have to take the market price. The market will basically tell you what you can charge. The rest, the other three examples of market structure, monopolistic competition, oligopoly and monopoly, are actually within those markets you are a price maker, because to some degree you have either some dominance in the market that allows you to decide on the price that you would like to charge, or alternatively, and possibly as well, you have a product that is sufficiently differentiated from the rest of the market and you can justify charging a higher price as a result. So let's take a look at this as we go then. So perfectly competitive markets have a high number of firms and sellers and also buyers. There are very low barriers to entry and exit into the market. That's something that we'll look at in a bit more detail, but fundamentally it means that pretty much any business that wants to, if it's got the resources to be able to do so, will be able to enter and exit a market without too much trouble. We've basically got a scenario where all the products are homogeneous, they're identical, there is no difference between the products at all, and as a result of that, the firms within the market have no influence over the price that they can charge, simply because there are many firms that are selling the product. The products are exactly the same, and so the market will essentially dictate what the price will be that you can sell at. Now, there are very few truly perfectly competitive markets, but examples that are reasonably close to would be the stock market, the commodities market, and the foreign exchange market, where essentially, if you think about each one of those, there are many buyers and many sellers, and the product is homogeneous and very similar, and the influence over price is, well, there is no, the individual firms aren't able to influence price, because the market and the demand for their products and services vary depending on what the market requires. Let's take a look at monopolistic competition then. In this case, you've got similar sorts of traits to perfect competition. You've got many firms in the market. You've got low barriers to entry again, but in this case, you've got heterogeneous products. Okay, so they are slightly differentiated from one another, and that means that in that case, you do have a small amount of influence on the price that you can charge. And examples would include takeaways, local taxi firms, local hairdressers. Essentially, they're all pretty much selling the same thing, aren't they? But if you think about a takeaway, they can choose to be Italian or Indian or Thai or whatever else, and each one offers pretty much the same product, but they can, to some degree, charge a different price as a result. Okay, let's take a look at oligopoly then. Basically, you've got a few firms that hold a very high level of market share between them. You've got also high barriers to entry. Now, generally speaking, those companies that are in oligopolistic positions tend to be quite big organisations. They've been around for a while. They've built up market share and brand presence, etc. And so, as a result of that, it would be very difficult for an individual company to come in, a relatively small company with small amounts of resources, to come in and try to compete in that market. As a result of that, there are high barriers to entry in that market. In that type of market. Excuse me. In an oligopolistic market position, again, we're likely to have differentiated products, so they're going to be different. They're not going to be identical, and the likelihood is that they will be highly differentiated. And obviously, the higher your points of differentiation are, the more obvious it is to your market that there are differences in the products and services that you're offering. Then that gives you a much greater influence over price. Okay, so they can actually justify, in some cases, a higher price ticket for the products and services that they're offering. So examples of oligopolistic markets. The coffee shop market in the UK is a brilliant example, hence the reason why we're looking at this. Car manufacturers is another one, and obviously supermarkets too, where you've got a few very, very powerful organisations, but also a number of smaller organisations within that particular market. Okay, so we'll just touch on monopoly too. So basically, in a monopolist, if you hold a monopoly in a pure sense, then there is just one firm that is offering the products and services to a particular market. You've got very high barriers to entry, because clearly it's very difficult for another company to come in and try to compete in your monopoly market. You've got particular, almost ultimate heterogeneous products here, in that they're unique. There are no substitutes. Okay, so again, in a pure monopoly position, there's no other game in town that people can go and buy their products and services from. In terms of your influence over price, that is significant. In a monopoly position, you might choose to possibly exploit that position and charge high prices as a result. Some examples of monopolies: Microsoft would be one good example. Waterboards and Network Rail, where in some cases they are given the right to operate as a monopoly. In certainly waterboards and Network Rail cases, it's where the government has essentially nationalised or privatised a nationalised industry and handed a monopoly to some organisations in the private sector. And so in some instances, like we said, there are very few pure monopolies these days in markets. But the way it can be defined is if you've got a significant market share, anything over 25-30%, you are considered to have monopoly power within a market. Okay, so that's a little bit on market structures and the characteristics that we need to bear in mind. As far as your answering the June 2017 paper 1 section A, it's specifically the coffee shop market that I want you to focus on. So that's oligopolistic market structure. Okay, so I'm not going to ask you to do this at this stage, but obviously just to sort of touch base and think about what it is that you know about oligopoly, and maybe go and do a little bit more research on that. There's lots of reference material on oligopolies and how oligopolistic markets work, and you just need to take a look on the internet to find that. Okay. Let's have a look then at some of the characteristics in a little bit more detail, so that hopefully you can understand that in a little bit more and make a little bit more sense of it. So you tend to find in this scenario an oligopolistic market is where you have a few firms and only a few large firms in the market. You do find that there are smaller firms that operate in those markets, but they're not going to have a significant impact on market share. Okay. Now, the one thing that oligopolies tend to compete on is something called non-price competition, which is what we'll look at in a minute. Now, obviously, in lots of instances, lots of organisations will think, well, I've got to compete on price, I've got to beat my competition on price. Well, that's true to a point, and clearly you've got to be offering at least value for money. But in some cases, if you think about how you might use things like promotion and advertising and highly differentiated products, that means that you can, in some cases, charge a higher price because you're maybe focusing on the quality and the innovation of your and the design of your product rather than just it's cheaper than everybody else's. Okay. Now, one of the issues around oligopolies is that where they have relatively strong market positions, in some cases, and in some instances, there are elements of collusion where effectively oligopolists might come together and then they will exploit consumers by charging higher prices. Okay, that's considered to be a bit of a disadvantage of oligopolistic markets, but clearly that can happen. Other characteristics to bear in mind: high barriers to entry and exit do exist in oligopolistic markets, and it's partly because of the size of some of these businesses allows them to spend an awful lot of money on advertising and research and development. And as a result of that, if you want to play in that same game, you're going to have to do the same to establish a brand, get your awareness out there, and also be constantly looking to innovate and change and improve your products. So in this instance, obviously, the ease of entry into a market makes it significantly difficult for small firms to move into oligopolistic markets. Okay. Now, obviously, one of the things to bear in mind is that if you're in an oligopolistic position, you're in quite a strong position, but there is also going to be significant amounts of competition too. And so, as a result of that, should there be changes in pricing decisions as far as some of your competition may be concerned, you may choose to then follow suit. And that obviously then affects the overall market. So those are some characteristics of oligopoly. Okay. Further examples that we need to bear in mind is that if we take the point that we just made, that if oligopolistic markets are constantly driving down price, then to some degree that's going to be a long-term strategy. That's not going to be a particularly strong one. And so to some degree, in the long run, oligopolistic markets don't tend to be massively price driven. They tend to be, it might be used as a bit of a tactic in the short run, but it will depend on making sure that they have products that are better and different and much improved over the competition. Clearly, the other thing that large oligopolistic firms will do is to use branding very strongly. So spend money developing awareness, developing some brand values, and also trying to get people to be loyal to buying their particular products or services. And clearly, if they're going to do that, they're going to have to produce products that are not just accessible, but also seen as innovative, seen as good value for money. And as a result of that, in some cases, some of the products in oligopolistic markets are pretty much homogenous. You could argue that the coffee market, well, coffee's a coffee, isn't it? Well, actually, if you look at the coffee market and particularly look at the video that we've referenced for you, even within the coffee market, there seems to be quite a lot of differentiation that's being used. It's not just about selling a cup of coffee for the cheapest amount. It's looking at how they can provide a nice environment to have your coffee, but also the number of different options that you can choose from. Now, a really good way of, and this is something that maybe you'll be able to use in your response to the exam question, is this principle of concentration ratios. Okay, now this basically is a way in which you can assess whether a the type of market structure that you're looking at is whether it's monopoly, oligopolistic, etc., etc. Okay. Now we've said that in oligopolistic markets there are a few firms that dominate the market, and this means that when we're talking about concentration ratio, sometimes known as CR, is that if you have a high level of market share that's concentrated in the hands of just a few firms, then you would have a high concentration ratio. Now, what I mean by that, and I'll give some examples and show an example in a minute, is that if, let's say, there are 4 or 5 companies, and they each have, let's say 20. Let's say if there are 4 companies within an oligopolistic market, and they each hold 20% of the market. Well, effectively, that would mean that the 4 firms in total, each having 20%, would hold 80% of the market in total. That would mean that the 4-firm concentration ratio in this case would be 80%. Okay, so 80% of the market being held by 4 firms would essentially give a concentration ratio of 80%, which clearly for 4. Sorry. So in that situation, that clearly would make it a very strongly oligopolistic market. Okay, now there are some examples that I've included there. So mobile phones as an example, the streaming music industry, and also the coffee shop market. Now that link is to the video that I've sent to you previously. But again, looking at hopefully having seen that and maybe review it again based on us having gone through this PowerPoint. There is some real good examples of how you could see, in this case, the concentration ratio, using the stats that you've got in your case study, in your exam paper. You should be able to arrive at the concentration ratio for the coffee market. Let's take a look then in this scenario then. Okay, so what we're saying here is that the concentration ratio, or the N-firm concentration ratio, is the measurement of market share of the number of firms that dominate the market. Okay, so if we said, for instance, in this case, our concentration was 3 to 75, that would mean that 3 firms have 75% market share in total. Okay. Now, clearly, if that is the case, if you've got a high concentration ratio, and in this instance, like the one there, where you've got 3 firms that hold 75%, that's going to mean that the market is concentrated in the hands of a few firms. So the majority of the market share is held by a few firms. Okay, so in this scenario, if we had that going on as an example there, to have an oligopolistic market, then if our concentration ratio was 3, okay, and what were 3 to 70, that essentially would mean that 3-firm concentration ratio of 70% means 3 firms dominate with 70% of the overall market share. Now, I'm not sure exactly what the numbers are in the exam paper, but you'll see that in this instance, it's demonstrating clearly that there is an oligopolistic market structure in play. Okay, let's take a look at some of the other issues to bear in mind then. If you're talking about oligopolistic markets, they are interdependent, and that means that if one firm chooses to make a change, then that's going to have an impact on other firms within the industry. And that interdependence is essentially going to create uncertainty, because some firms may not know what their competitors are about to do, and whether they will need to be proactive in the market. So this interdependence and uncertainty are definitely linked, and firms within oligopolistic markets will constantly be looking to try to anticipate what their competition are doing, and effectively, if you think about if you look back at the video, that's exactly what all of the big coffee market oligopolistic high market share owners are looking to do, because they want to try and maintain that position, try to get to a position where they have a dominant market share, where they can then maybe even dominate price decisions because they are a market leader. Okay, so in some cases, what can happen is that some of these big organisations, it becomes a bit of an old boys, or an old let's call it an old boys club, So effectively what they might do is they might actually talk to one another and say, well, okay, we want to make sure that we're not going to damage one another's prospects, and may actually in some cases collude. That's considered to be illegal, as we can see, based on the slides that you're looking at the moment. But in this situation, there are, in some cases, oligopolistic markets might choose to be cooperating with one another, but in some cases they might be setting prices at a level, and that might be exploiting their overall market position. In some cases, they might do that in a very genuine way, where they may be looking to innovate with new product processes so that actually the society can benefit as a whole. Because if lower production costs can be achieved, then that might mean that those consumers who are buying those products and services will benefit from better value pricing. So in terms of some of the sorts of things that might happen, and this is the sort of thing that I just want you to have a think about, we've got a concentration ratio of 4 to 80%, so 4 firms own 80% of the market, and in this situation there are a number of different options. So there are a number of different firms within the market. One is looking to raise price. Firms B, C and D choose not to do so, and if they choose not to do so, they will actually gain market share from firm A, who are likely to see a large drop in sales, because if there are similar products that are at a cheaper price, then in that case that would surely, particularly if we're talking about the demand curve being price elastic, that's clearly going to then have a bit of an effect. Okay. Now, again, if we then take another example where, let's say, firm B chooses to lower prices, most consumers will choose to switch to them. And if A, C and D, in order to retain their market share, they might have to then lower price. So you can see this interdependence going on. But in lots of instances, because of that change, and because if one firm chooses to make a big change, a big long-term change, that's going to mean that effectively, under these conditions, that there's less likely to be price changes or a massive increase or decrease in price, simply because of the effect that it has on the whole of the market. Okay. Now, we're not going to focus on this. There is some theory which talks about the reason for that, which is something called the kink demand curve, which is there for you to take a look at. But for the purposes of this is something we'll come back to and look at in year 2 in a bit more detail. So I'm just going to flick through this one and that one and that one, and that one too. That's just a bit of an activity that you can take a look at, which is to do with considering concentration ratios, and that's just a bit of practice, really. So let's take a look at different types of price competition then. Okay, so clearly one of the things that we can do if we're in a strong position, we might choose to use price, although we've said that in most instances oligopolies tend to focus on non-price competition. In some cases they might choose to give the market a bit of a shake-up. So in some instances we might actually be engaged in some sort of price wars where a firm lowers prices in order to increase their market share. If they do that, other firms that don't react are in danger of losing market share, and so they're probably going to lower prices too. Now, clearly, in this case, the consumer is going to benefit from lower prices, but all oligopolistics are going to lose out in terms of their overall revenues and probably also their profitability. Okay, but that sometimes can happen. It tends to happen quite a lot in the supermarket sector. So that's something that you maybe at the moment, Sainsbury's, I think, are doing like a price match with Aldi, aren't they, as an example? So that there's an example of a short-term tactic to try and demonstrate that Sainsbury's are actually being price competitive with the discounters. Another example could be predatory pricing. So that's where a firm tries to force competition out of the market by setting very low prices. Now, in some cases, they might set prices at below their average cost in the short run, because that might see an increase in output as demand could be higher, so they might be seen to be gaining market share. But also, obviously, you can only do that for a short period of time. You can't be constantly selling at a price which is actually below your average cost. So it can only be a short-run tactic. Limit pricing is where basically we have, excuse me, firm operating at below its profit maximizing output of MC equaling MR. That's something again that we'll come back to look at a later stage. But in that scenario, the firm will in this case try to deter new people coming into the market by setting a lower price in the short term that means that those people that are considering coming into the market will see that there's not enough profit to be made, and so that might actually cause them to move away from that market. Again, more articles that we'll come back to and look at in year 2, so we're not going to dwell on that for the moment, but that's something you could go and take a look at in your own time. And we also need to bear in mind some price discrimination. Okay, again, I'm not going to go into this in a massive amount of detail. I just want us to understand that in some cases we talked about price wars and price competition. And the other thing that in some cases there is in markets is something called price discrimination, okay, where a firm, if it's really got a real handle and a clear idea of what different consumers want and why they're buying their particular products or services, they might actually be able to charge a price depending on the consumer's ability to pay and their willingness to pay. So that might mean that exactly the same product is being sold at a different price to different types of consumer. Okay, it's not considered to be illegal, not even considered to be sharp practice really, but it is in terms of it actually happening in real markets. Well, to some degree, it does happen. Okay, so examples can include first, second, and third degree discrimination. So let's look at first degree discrimination, or perfect or pure price discrimination, and that occurs when a firm is able to charge the maximum possible price to individual consumers. So basically what it will do is it will actually have found out what a consumer can afford, and it will charge the maximum price that it thinks it can get away with. Okay. Now if we take second degree price discrimination, that's when you basically a firm will charge the maximum possible price to a different group of consumers. So it will have actually looked at the different types of consumer, and then try to see what price range they're willing to pay for. Okay, and then we've got third degree price discrimination, where a firm identifies a group of consumers with similar characteristics and then charges at a particular price as a result. Again, I'm not going to run through the illustrative and relatively technical diagram that we got for first degree price discrimination, but just to be aware of this principle. Okay, so what we'll do is just move on and take a look at some of the advantages and disadvantages of price discrimination. Okay, so in some cases, obviously one could argue that if a business is smart enough to be able to price discriminate and to be able to demonstrate why to their consumers why they're being charged this particular price, then clearly that is going to be a great advantage to a business. It does assume that you've got your finger right on the pulse in terms of what's happening in the market, and how are you in a position to be able to be flexible enough to charge lower prices and change demand as a result. So it's there are some advantages clearly. Now, the other thing I just wanted to dwell on and speak a little bit about was the other alternative, and this is another question that you'll see in section A, where it talks specifically about non-price competition. Now, if I remember rightly, I'm just taking a look at it's question G. Assess the importance of non-price competition in the UK coffee market. So non-price competition is exactly what it says on the tin. Okay, it's where you're not necessarily just competing on price. Okay, now in this situation, in certain market structures, particularly in oligopolistic markets, there is an awful lot of non-price competition, okay? So it's not just about we're the cheapest, we're the cheapest, we're the cheapest, and in a race to the bottom of being the cheapest. And the only way that you can maintain that and sustain that is to become the lowest cost producer. Because if you're the lowest cost producer in a market, then if it's just based on price and nothing else, you're always going to be able to drop your price slightly more than somebody else if your costs of production are less than everybody else's, okay? But however, what organisations might do in oligopolistic markets, and hopefully in other markets too, is to try to find reasons why why consumers will buy products and services. And they can be non-price measures. So for instance, it could be through marketing an exclusive range of products, for instance. So that gives some sort of scarcity value. It might be a limited edition type approach that you might take. And that might mean in that case that you're adding some scarcity value to your product offering. And then as a result, the price doesn't become quite so important. If people want your product, they might be willing to pay a little bit more for it, a considerable amount more for it, because of the way in which you're marketing has suggested that this is an exclusive offer to them. Other things like using the use of branding and advertising to differentiate your product from the rest of the market. Again, think about the coffee market, the coffee shop market, the supermarket sector, constantly bombarded by advertising, branding, talking about all the things that why your product is so much better than the rest of the market. Okay, and then the last area, although there are others that we can talk about in terms of promotional sales promotions and testimonials and all sorts of things, emphasizing the quality and innovation that you have within your product range. Okay, so it might be higher quality materials, it might be better innovation, it might be higher quality design, it might be more desirable, a whole range of things that might actually allow us not to just be focusing on price and how the fact that we are cheaper than everybody else. It's just being able to justify that higher price by you having a unique quality or being uniquely innovative in the way in which you're approaching a market. And that obviously then means that it's not just a case of we're the cheapest. So non-price competition is really looking at areas where you can hopefully justify a higher price. And obviously, if you can justify that higher price, but also keep your cost of production at a relatively low level, then you're going to be able to generate more profit as a result. Okay. So I think we're going to stop there. Pretty much that covers some of the key areas that you're going to need in section A. I'm going to post this so that you've got it in time to have a look at it for your lesson on period 3 on Tuesday. And notwithstanding what I've said, we will also look at doing a live lesson on Friday, where hopefully with a combination of you having looked at the exam paper, try to do a little bit of planning on that, and also taking a look at this, you might be in a stronger position to put your plan together, and then we can discuss that in more detail on Friday. Okay, so thanks for listening. I know that was a bit of a quick tour through that, but we will come back to look at some of the more technical details in year 2. Okay, so don't worry about that. We will come back and cover it. This is just really to help you to be able to answer the questions that we posed for the on the question paper that we set for you. Okay, so I'll talk to you soon. Thank you.